Today we'll be covering two general topics of interest related to innovations in CLOs. The first is innovations within BSL CLOs that market participants are seeing. The second is innovations that are being adapted to other new asset classes such as CRE CDOs, infrastructure CDOs, TRUP CDOs, and CFOs. And the innovations that we're seeing in the CLO market reflect the current dynamics in the market, which are strong investor demand, tightening spreads, and competition for assets. The innovations that we're seeing in other CLO-like products are also reflecting investor demands to diversify and increase yield while still maintaining leverage needs and the needs of the collateral holders and the managers. So the first topic we'll cover relate to the BSL CLOs themselves and what type of innovations we're seeing there. So we'll start off with the general question of, what is the panelists' view on innovations within the BSL CLO structures? What are the drivers of those innovations, the key features, impact on investor classes, and impact on liquidity? The first topic we'll cover are the equity-friendly features. So we're noticing that more deals have these equity-friendly features, which could include things like par flush, refinancing with majority vote. So I'll pass it to Konstantin and Niraj to maybe discuss this topic first.
Sure. Thanks, Joe. So I can start briefly. Basically, one of the equity-friendly feature that we've been seeing recently since beginning of the year is what Joe said, like a permanent par flush feature. This par flush feature used to be, it exists in most of the 2.0 deals where the asset manager has the ability to flush out any excess par that resulted from trading gains through the interest waterfall to the equity investor prior to the first payment date. Then recently we saw developments where that option was available to the asset manager, even on like refinancings. And recently we've seen that asset manager has an option of passing that excess par out to the equity investor on any payment date. So this, of course, the magnitude of that impact to the equity investor is undetermined due to like the timing when it passed through to the equity investor, but directionally, it only benefits the returns to equity. In most cases, we've seen that it's limited to 1% of the target par. So if it's a $500 million CLO, over the lifetime, you cannot pass over 5 million of the trading gains. And there are certain requirements that have to be met where, the quality test, the concentration limitation test have to be passing, and then the junior OC has to be above like a certain threshold. So that's typically what we've been seeing in the documents in few deals recently. I'd be interesting to hear, of course, Konstantin might have a view of how the debt investors are receptive to that.
Yeah, so the par flush, the perma flush, so-called perma flush, obviously has been talked about a lot, but it actually hasn't been implemented in that many deals. So I think in many situations, what happens, it's just part of the negotiation between the debt and the equity. That feature drops out. Obviously, there's other limitations as well. For that, there has to be some excess par built, and actually that's a kind of a variation, between the few deals that has been done. Basically, what excess par is it 0.1%? Is it 1%? If you look at how much excess par transactions have built, if you put a 1% excess par limit, actually, going back in time over the last 4 or 5 years, that severely limits the number of transactions that can actually even execute on this feature. Just want to very quickly, I know we have to cover all the ground, just mention a couple of other things as well that have kind of been evolving over time. We don't really see anything revolutionary the last couple of months, but what has happened over time is the reinvestment, after the investment period criteria have evolved. A couple of years ago, there were managers who had to accept, only 50% of prepayments could be reinvested, or 75%. Now, practically, that doesn't exist. It's all 100%. There's some other limitations, again, that used to be, more stringent. WARF had to be satisfied. CCC bucket had to be satisfied. the 7.5% limitation, while had to be satisfied now. Obviously, there's all these, variations that are, happening to a different degree. I think it's been slowly, moving to the direction of having, fewer constraints on those. Then another thing we're seeing is some of the collateral quality tests. What they try to do is basically, again, this has to do with excess par, but basically the transaction can remove or not take into account any excess par from the calculation. And obviously in that excess par, for example, if you're measuring the WAL, you put in the longest assets in there. So again, this seems very, it is just a way to push the envelope and make the compliance slightly easier. But again, these are, in my view, these are things on the margin because again, the deal has to have excess par built for that to happen. And a little bit on voting rights as well. Obviously, with the reset wave, what has happened now, a vast majority of the deals can do resets with only 50% of 51% of the equity voting instead of 100%. So that simply means that we obviously are aware of deals that are not resetting or refinancing because not all of the equity is immediately visible. Or the equity, or the multiple equity investors cannot agree. So obviously that slows down the time when these transactions can be refinanced. Now, going forward, some of these will get refinanced faster. Again, I think it's kind of a marginal effect of that. So that's it. One last feature, it's not that major either, is we see a risk-adjusted par balance introduced into more deals when we're measuring compliance with the so-called restricted trading period. The restricted trading period simply restricts the ability to do discretionary sales and post reinvestments in some scenarios. So instead of having to have a target par amount flat from the beginning of the deal, the par amount declines by 0.6% per year. So that's it.
Thank you. And Eric, from a rating agency perspective, how do you view these additional equity-friendly features, and how does that affect your analysis?
Yeah, I mean, I think a lot of this stuff, you have to look at the documents and really understand the scope and how much it could impact, right? Look at kind of the specifics, how much par can be eroded. It's usually pretty well defined. And I think a lot of these features, leaking trading gains or, even leaking excess par at effective date are not new. They have been around. We have seen them before. And, you want to look to see, what is that minimum amount of par in terms of like a par flush feature has to be maintained after that par is flushed out. And that's effectively the level that you're going to use as your basis for assigning the rating, especially initially. If that par can be eroded to a lower level than the quote-unquote, effective date target par, then that's probably the level that you're going to have to analyze the transaction to. Typically, a rating analysis does not rate to any par build at close. So while it is a benefit to debt holders, during the lifespan of a CLO, and it adds extra cushion, down the road, it's not something that is given credit to up front. So from a ratings perspective, kind of throughout the life cycle of a CLO, one effect that it could have is it could limit your upgrade potential. So if this feature exists in a vehicle and a manager chooses to utilize it, if there has been par built over the life of the deal, those lower rated tranches, anything below kind of AAA, likely would be restricted from getting any ratings uplift because that cushion could be diminished at different points in time. I think there are a couple of other features that have been observed that are I'd probably call equity friendly. I think as you see the loan market, the yields on loans getting stressed and managers trying to make the equity return hurdles that they have to. You see some creativity coming around in OC test calculations. Triple C haircuts, for instance, right? Those are assets that might provide a little bit more yield. So there have been carve-outs where they try to introduce any triple Cs that are trading above 100% market value to be carved out of that 7.5% OC haircut limitation. So really, in this kind of stuff, you really just want to make sure you understand the scope of it to the extent it can be measured, and run some different sensitivity analyses kind of upfront to assess the impact that it may have during the life cycle of a CLO as you're assigning ratings to it. Similarly, long-dated obligations, which again could provide assets outstanding for a longer duration during the life of a deal, which could create some back-ended market value risk. If transactions have that ability, you just want to understand what the scope of that is, and maybe run some sensitivity analyses up front, just to see what effect it might have, and especially lower in the capital structure, where they may be more impacted by potential back-ended market value risk. It's important to consider all those factors.
Thanks, Eric. So the next two features I'd like to touch upon at this time is one, LIBOR mismatch, and two, AMR, which is applicable margin reset. So for LIBOR mismatch, what is driving this mismatch, and how much has the basis moved? How has this impacted CLOs? Could you quantify and discuss the impact on the different investor classes? And then for the AMR, could you please introduce that concept for folks that are less than familiar with it, and the different structural features of that?
Sure. Thanks, Joe. I can start with the LIBOR mismatch. So recently we've seen the basis between 1-month LIBOR and 3-month LIBOR. Historical 5-year average is around 12 bips, and as of today, it's like 40 bips. So underlying asset documents have given the option to the borrower to choose to pay interest over 1-month LIBOR versus 3-month LIBOR. And as the basis between them has increased, more and more borrowers are exercising that option, to the extent that currently over 50% of the assets in US CLOs pay interest based on 1-month LIBOR. And all the CLO tranches, most all the CLO tranches pay on a 3-month LIBOR basis. So it's just, the CLO is receiving reduced interest and has to pay higher interest out. So that reduces excess spread that flows through the equity. So just like, quantifying it, if there's a deal with 50% of your assets paying over 1-month LIBOR, and the basis is 40 bips, and the equity is 10 times levered, it's around 2% annual cash flow that gets decreased to the equity just because of this mismatch. So the industry has been thinking about solutions. One document we saw was, give the ability to the collateral manager to choose the index for even the CLO tranches as like a 1-month LIBOR if a certain threshold is hit for like the assets paying over 1-month LIBOR, but then I'm not sure how much receptive was that to the debt investors. Other solution could be to put like hedges on top of the basis hedges on top of your deal, but that could be expensive given the widening of the basis right now. So I'm not sure if Konstantin wants to add anything.
Just to add a little bit more. So first of all, the one thing, obviously, it's a hot topic right now. I walked into a panel last night, and that's what it was about. I heard it was discussed again today, so I hope we're not overlapping here. But one thing people are missing when talking about how much this is impacting the equity is that people comparing with this kind of a hypothetical scenario when all of the collateral is 3-month and there's no basis, or one of the two. The reality is that even in the tightest the basis is about 10 bips, and the lowest concentration of 1-month LIBOR collateral in the pools, if you go back a year or two ago, it was 25-30%. So really, what has happened, at least so far, is gone from 30% monthly to 60%. So the increase is only 30%, and then the LIBOR basis has gone from 10 to 40, right? So it's 30 bips on 30%. It's about 1% of equity return. Again, I don't mean to diminish it, but that is kind of the comparison that should be made. And obviously, people are concerned that another 30% of the 1-month LIBOR collateral of the 3-month collateral will switch to 1 month. And then obviously, if the basis continues to widen, that will multiply that effect. So what we have seen, I just want to share. So first of all, we've seen some of our equity clients are obviously doing runs that more properly. In a new issue deal, typically you have rep lines. A lot of time, the modeling is sloppy. Just put a 3-month LIBOR rep line in the pool and run the transaction. So we've seen a little bit of a shift to have more granularity in selecting those assumptions. Basically, half of the collateral should be accruing 1 month and 3 months to kind of get an accurate picture of the equity returns. And then in the docs, as Niraj said, not much has been done. One potential scenario is obviously we have, the CLO is a small universe of the entire structured products. A lot of other structured products have, monthly liabilities. So I don't know why it's not possible to have, a 1-month payer. Obviously, the investor pushback has been on the possibility to have a 3-month payment frequency with 1-month index, but obviously there's numerous products that pay off 1-month LIBOR. So maybe something like that can be structured.
Thank you.
Joe, can I just ask
Yep, go ahead.
add something on the rating side? I think now that this has been obviously brought to everyone's attention and it's kind of on the forefront, I think it's important in looking at kind of CLOs and running that initial analysis to run some sensitivities around this, right? To see where this can go. I think like a lot of lessons learned from the past. Some things weren't really thought about at top of mind, but once they are brought to kind of our attention, it is important to just see what impact it could have on ratings as we're looking at deals and assigning ratings. I think it's probably more impactful, this mismatch, especially if it widens and becomes more, prevalent for lower rated tranches, that are more reliant on excess spread. But I think one other niche in the market that, it could have an impact on is in combo notes, right? Where you might have a significant reliance or component in that combo note of equity. So when kind of looking at combo notes, assigning ratings to combo notes, it probably is important to, be aware of this potential, reduction in excess spread and test that out to see, how much credit you should or should not be giving to excess spread in those analyses.
Okay. And Konstantin and Sonal, do you want to touch upon the applicable margin reset, what that feature is and what the impact you're seeing is on the structures that have it?
Sure. So I'll be, obviously we're front loading the panel. Everyone will get their turn. I apologize. This is my last sort of bit here. So I'll try to be very quick. So the AMR, or the applicable margin reset, is basically an auction-based bidding process that allows the spreads to LIBOR of the CLO tranches to be reset to new tighter levels after the expiration of the non-call period. So the CLO notes are, in such transactions, are subject to a mandatory tender under the DTC protocol upon successful auction. The process, just like a refinancing, can be triggered by a majority of the equity or in some cases by the manager. Before the, so basically the equity puts up a notice. There's a scheduled pricing and closing date, just like a refinancing. The only difference is that the auction happens on that pricing date as opposed to going through a book building process that is done in the traditional refinancing methods. So before the pricing date, information is distributed about the auction is distributed to participating broker dealers who bid on behalf of their customers as well as for their own book. And before the deadline, bids are submitted to there's a software platform called the auction service provider. It's basically an independent calculation agent who simply basically takes in the bids and calculates the results in a formulaic way. There's no last looks. There's no conditional orders of let's say an investor coming up with I need double the size of the AAA that you're going to give me on the AA. So it's a very sort of formulaic. It's very objective process. The bids are in the form of size and spread only. The price is always par. Once the bidding is closed, this entity, the ASP, calculates the results, and the clearing level is simply calculated by sorting all the bids from tightest to the widest level, and we basically select the tightest level that clears the entire tranche. And then the allocation is very simple. Any bids that were tighter than the clearing level will get 100% allocation. Anyone who was exactly at the clearing level will get a pro rata allocation of whatever bonds are left after the tightest bids are satisfied. Again, needless to say, the whole tranche refinances at the same spread level. That's basically it, and I just want to touch on how it's been received. So some debt investors think, again, this is just another additional optionality for the equity at the detriment of the debt. It makes refinancing easier. Again, maybe on the margin that is the case, but I think it's just more efficient. It's a cost saving basically for the entire system, the entire market, for all the investors. It's a transparent process. It's more democratic in that smaller investors can participate, right? And they can also bid tight, because obviously if you're, let's say you're buying a 5 million slice of a AAA tranche, you can bid tight and have no fear that you're not going to be the one determining the clearing level and everyone is much wider than you. You will basically get your allocation at the clearing level effectively, right, which is presumably going to be higher than your the spread that you bid. That's it. Now, why it hasn't been more widespread than I think it should, it's I think part of the reason is that recently the resets are dominating the refinancing. So on the equities mind, their biggest, and obviously we're talking about 1 month LIBOR, 3 month LIBOR. So on the equities top priority list is not how I can do cheaper or more efficient refinancings. It is more, there's just other issues, but I think as more deals get done, it's going to become widespread once people realize the advantages of it. And again, there's in the deals that we've done, in particular, the debt investors, in exchange of accepting the AMR, were able to negotiate other steps, which were either adjustments of the AMR process or completely outside, basically like a trade. So people have found value in those transactions as well. And as far as the equity goes, it also gives flexibility to refinance individual tranches. And again, it's not cost prohibitive, right? So if today, the single A's are really tight compared to, double A, okay, we just refinance the single A. That's also a possibility.
Yeah, and just to sort of expand on that, BNY Mellon supported the first CLO that utilized the AMR concept. And so this is obviously the auction repricing mechanism that was mentioned earlier. And this was really in partnership with our markets team that's really a broker-dealer. And you really need to find a broker-dealer that is sort of sophisticated in matching, various investors in the market with surrendered securities to really sort of understand how the auction process works. And, the mechanism has allowed where all the parties were able to reset the interest rate on the deal without, the traditional costs and things or time that really needed from a refinancing or a true underwriting perspective. So I think there is a huge cost savings, and, all of those cost savings are, as mentioned, are passed on to the equity tranche holder, which is very beneficial for, the entire transaction. And just from an operational perspective, the way it works is that at the trigger dates, the investors submit interest rates and what they're willing to receive to own the funds. Obviously, we would collect all the offers and make sure that there's sort of a fair sort of assessment process, which, as you can imagine, if you're contemplating the AMR concept in your structures, it's an operational sort of due diligence that really needs to be done. And in that process, the offers must be lower than the existing spread, which is, huge and significant. And that sort of, concept has taken on. We're hoping to see that the AMR, concept is across a lot of the CLOs that are being issued. But obviously with the reset, sort of financing increasing in the market, I think, we're probably not going to see as many. But in terms of just folks that are contemplating that, there is an operational nature and due diligence that's been very successfully done in the market.
Okay. And Robert, I'd like to bring you in next to the conversation, which is to discuss another feature of BSL CLOs that we're seeing, which is the make-whole periods. Do you want to introduce that topic?
Yes, thanks, Joe. Some deals do contain make-whole periods. I think if on a typical CLO, a make-whole period is kind of the opposite of a refinancing or an AMR. So to some extent, and I think in looking back on, years of doing transactions, the notion that you could close a deal and then within 2 years actually refinance it and, take out investors, or even better, reduce, essentially reprice them, is somewhat unusual. It has been very effective, but some investors have been successful in getting a make-whole period provided for themselves, so to the extent they were taken out earlier than they would otherwise like or desire, they are, basically made up for the return they would lose. I mean, that could be based, on an absolute basis, that could be based on a spread basis. So I can't say it's common, but it does appear in some deals.
Yeah, I mean, the deal we saw recently was, was actually like a 1-year non-call period. So that was atypical in itself. And then the make-whole period was for 2 years. So if, let's say, the senior investors got taken out right after that 1-year non-call period ended, they would be compensated for that additional period. So just to add something, one debt-friendly feature, apart from the equity-friendly features that we have been discussing.
All right. And the last kind of sub-point on the innovations within BSL CLO structures would be distributed CLO warehouses. So the warehouse itself is not, a new or innovative feature. It's a critical part of the CLO process. But what is the innovation is that some of the risk of the warehouse is being distributed, and that distribution is also occurring in rated format. So I know we've seen it at DBRS, and maybe Eric could speak to it as well. But we've seen warehouses that have been requested to be rated for regulatory purposes were basically brought in to analyze the default and loss severity risks, not market value, but the actual term risk of default and loss. Basically, we use the same approach that we use to rate CLOs that we do when we analyze a warehouse. Basically, we've adopted, or a lot of managers and banks have adopted kind of a matrix format. So as the CLO warehouses are ramping up from 0 to multiple assets, there's different points of leverage that are trade-off with the different collateral quality tests or concentration limitations. So I don't know if, Eric, if you have anything to add on maybe warehouses.
Yeah, I mean, I think the inquiries in this space have definitely increased. I think, historically, those inquiries would come in surrounding kind of middle market portfolios, middle market lenders that utilize some of these warehouse facilities that they might have looked to have ratings assigned to. We're seeing more inquiries now come for BSL warehouses. I think, historically, there might have been a mismatch in kind of the asset liability timing, and that has always been kind of a challenge when looking at from a cash flow, CLO methodology vantage point, right? Because that introduces more market value risk than, might be assumed in just a regular way cash flow analysis. But I think a lot of those hurdles have been, solved for. I think as you see more insurance companies looking to get exposure to kind of leveraged loans, they're the ones who need the ratings for their kind of NAIC kind of, and others for regulatory capital. So that's why the kind of increased demand for the ratings of this product, I think, has really come about.
Okay. So I think we'll switch gears a little bit outside of the innovations within the CLO products to how those are applied to some other asset classes. So some other asset classes that we see, investors driving, some demand for, some hunger for, is CRE CLOs. So some of the topics we'll cover next are CRE CLOs, infrastructure CDOs, TRUPS CDOs, and CFOs, to the extent that we have time to cover all. We'll start with the CRE CDOs. So Dave and Robert, do you want to discuss some of the key features, the drivers of the demand of CRE CLOs, comparisons to other CLOs?
Sure. Thank you very much, Joe. At the risk of being provocative, is the CRE CLO the rebirth of the CRE CDO? The clear answer is no. The reality is the CRE CLO is homogeneous in terms of the underlying asset class, generally 3-year pieces of paper with 1-year renewables. It relates to transitional properties as opposed to a smorgasbord of assets that you would have in a CRE CDO. So the essence of the underlying asset, as well as the nature of the reinvestment periods in the two types of deals, radically different, to the extent you even have a reinvestment period in a CRE CLO. Maybe it's 3 years. In a CDO world, it was 7 years. Advance rates, much more conservative. So you have an animal that is simpler and cleaner. The question really is, what is it most analogous to in the context of the CLO world? Is it a BSL or is it a middle market? And clearly it is middle market in the sense that there's an inherent stickiness to the party originating the underlying loans. That's true in middle market. Middle market CLOs, you have the party sponsoring the deal really understanding the credit as well as the private equity sponsor. In the context of the real estate world with the CRE CLO, you have somebody understanding the sponsor, the borrower, as well as the management company attendant to that piece of real estate. So the comparison, I think, is more on point there. You also have risk retention. The bottom line is the BSL world had the advantage of what has happened recently with the LSTA win. Risk retention is present. And frankly, if you're a REIT and you're a participant in a CRE CLO world, you have to retain everything less than investment grade for tax purposes. So there has always been a more aligned interest in the CRE CLO world than the BSL world. So those are just some maybe overarching concepts and differences between these various structures. I don't, Rob, do you want to add something?
Yeah, it's, very well put. I think when we did series CLOs kind of in 1.0, a lot of times you would take basically a CDO document or a CLO document and dupe it and just make it for real estate. So as Dave said, the trading provisions were written so as if you were buying assets in the open market. When the financial crisis hit and the sponsors of those deals needed to adapt or whatnot, I mean those provisions were taken were utilized quite aggressively. So investors in the second go around have limited the ability to trade in and out of those those vehicles much more so than in the first wave. So I think you're very much you could assume that the pool throughout its life will be much more closely resembling to what you bought. And I think the information reflects that. I think in a standard BSL CLO, if you pick up an offering document, there's probably some lying around, you see nothing specific about any loan. So it's assumed that these are loans, the largest piece is a 1% or 1.5% of the portfolio, and you don't really need to know anything about a property, whereas in a CRE CLO, the loans are much lumpier, they're relatively larger, and you do know, and the investors do look through and analyze, individual properties depending on how the concentrations go. I mean, some cases they could do, analysis in every property or the top 10 properties. It all depends.
The reality is it's a painful process in the sense that it is at some level a CMBS product, and as Rob said, top 10 level disclosure for each property, for each loan. It's very granular. And it's a difficult process. The irony is as the CRE CLO market expands, you're starting to see revolving periods and longer revolving periods. So the irony is you start off with a deal that has very explicit disclosure on each property and each loan, and then as you get into the revolving period, you have eligibility criteria not dissimilar from a middle market CLO, right? Concentration, et cetera. So yes, you spent all this time and energy putting together this disclosure book that has this granularity to it, and then by the end of the deal, you have eligibility criteria generally. So it's almost as if we're moving away from the more basic type of deal with that attendant risk.
And Sanal, anything to add maybe on liquidity or the investors or?
Yeah, I mean, obviously, private equity and debt have both done very well, and the investor sort of concentration in both of those types of asset classes and funds that are in the market, they're looking also for diversity. And, CRE and direct lending have the greatest appeal. And why is because they are steady in terms of the yields that they do offer and the way that they're structured. So even if it is in sort of a CLO or a CRE CLO or a real estate type fund, you're dealing with these commercial assets that folks are still sort of trying to understand the performance on. I think pre-credit crisis, there was a lot of scrutiny around some of these commercial assets and in terms of monitoring and servicing and sort of the allowance of what actually happened in the housing space. And post-credit crisis, there is still technology that needs to be done that investors are still looking for as it relates to the commercial assets. I think, don't underestimate that sort of loan asset class because it's very, very different from a syndicate loan. I think, in terms of just really being a real estate loan. And the investors are really, one, looking for diversification, but they're also demanding more transparency and information as it relates to the structure of a CRE CLO.
And to that point, a key element in these deals is special servicing. Who is the party that's going to take care of that underlying asset when things go sideways? So that entity's financial viability has real meaning as well as their experience. And frankly, in the CRE CLO 2.0, there's been the concept of the operating advisor that comes to the table and reviews their performance at one level. At a second level, if things start going sideways as it relates to the deal. So there is some protection as it relates to the performance of the special servicer in this context.
Yeah, and this obviously poses some management challenges, right? So when, equity managers or private fund managers are sort of managing CRE CLOs, the industry's changed a lot. And what's happened is that the investors are just making so much more demands on what the information is that they're looking for. And the tracking mechanism that's really needed for the CRE CLOs needs to be very robust as it relates to kind of the servicer really stepping in to, take cause if there is some sort of downgrade of any sort. So there is a lot of scrutiny in terms of that poses a lot of challenges to really manage effectively and manage the effective sort of liability of the investors as well.
Okay. The next two asset classes, just to aggregate them in the interest of time that we want to touch upon, would be infrastructure CDOs and Trust CDOs, and what are the key features there and how they might be adopting CLO technologies. So maybe I'll start with Robert.
Thanks, Joe. So we worked on an infrastructure CLO last year. Kind of think about, well, what are the differences? I mean, the interesting part about the CLO structure is that, as we've seen, you have this suite of papers that have been used, and we've used them to do the ABS CDOs, the CMBS CDOs, the TRUP CDOs we'll get to. But if you also, so it's essentially a structure designed to issue tranche debt off of called lumpy assets, and which are loans, bigger loans. And there is a market out there of loans that are are related to infrastructure type activities, whether it's power generation, airports, and there are really actually two types of loans. There are loans that are actually backed by the projects themselves, and there are loans that are made to companies that are kind of in the infrastructure business. And through some customization of a standard set of CLO documents, you can create a deal that is backed by infrastructure-specific loans. Now, from a substantive matter, these loans may differ from a broadly syndicated loan in that, I think from a credit perspective, they tend to have different types of categories rather than hospitality or lodging or the same thing, or food and gaming. You categorize these assets for concentration purposes by their purpose or their region. And that could be used to create the diversity tests that are similar, kind of a parallel universe to what is created, in a broadly syndicated leveraged, loan, CLO.
Okay. Eric or Sanal?
Yeah, I mean, I think just with infrastructure, it's not an asset class that has this sort of longevity of performance results, right? So I think that when you really talk about the investor base, they're still looking for performance of record as it relates to just the infrastructure asset class. I think with various projects that are out in the market, you know, whether or not it's sort of something that is making them feel good about that project or investment in that project, I think that there's still some scrutiny around the performance of the asset still, because there's not enough, I would say, predictive analytics to really sort of qualify, you know, the performance of it.
And is there anything anyone wants to touch upon specifically for TRUPS versus infrastructure?
Yeah, I mean, I could speak a little bit on TRUPS. I think, you know, KBRA, we've rated a few TRUPS deals as of late. I think looking kind of a comparison between a 1.0 versus 2.0, I think there's much more transparency in the 2.0 world. Structurally, there's a lot more credit enhancement, you know, and subordination. If you look at the TFIN's 2018 deal that we did under the single A rating, it was like 25% subordination. You know, I think the 1.0, you probably had 8 to 10% subordination under a single A. I think it's an area where we view as a strength of ours, given, you know, the fact that KBRA publicly rates over 115 community and regional banks, which are the ones who are providing the debt to a lot of these vehicles. You know, you're also seeing a difference in, you know, maturity profiles in the 2.0 world versus the 1.0. I think the trust preferred securities that are being put into the 2.0 deals are really coming from liquidations of 1.0 deals, so it's a shorter maturity profile. So now you have 20-year, 10 and 20-year assets versus the, you know, the 1.0 30-year assets. So that kind of changes the profile. You know, the 1.0 deals used to have hedges in them to mitigate any fixed float risk, and I think there's a better matching of asset and liabilities in terms of the fixed and float nature of kind of what the 2.0 looks like. It's still a limited space just in terms of availability of collateral, you know, and liquidity. But I think, you know, insurance companies do have an appetite for this, and that's what's driving some of the ratings demand on the TRUPS CDO product.
Thanks. I think with that, we've pretty much used up our allotted time, but feel free to come to us with questions afterwards. But please join me in thanking the panelists.